Hello, welcome to another talk on money, business, and investment. My name is Jose. I'm the founder of the company and brand here at Master Investor. Ensure to subscribe to our channel, turn on the notifications so that we know when we go live or upload a valuable talk on money, business, and investment that can literally change our finances as long as we apply the information that we're learning. And this information age is all about knowledge. It's all about acquiring the right context when it comes to wealth. It's more important than the content. Today, we're going to have a theme on how to invest in real estate for cash flow. That's going to be our topic. We're going to dive into our article. At the end of today's article, we have a bonus, and that is that we're going to discover why investing in multifamily is superior to 401k. Remember, investing is about having a financial plan. It's about having a lucrative exit strategy in a winning business. Where we're going to find total freedom is from the assets column. We have to focus primarily on the assets column. Master the 7 proven strategies to win at investing and secure our retirement. Summary: there are numerous ways to make money. Before we start investing in real estate, make sure we understand the differences. Making use of these 7 real estate tactics can significantly impact our investment portfolio. Keep in mind that we will need to keep learning new things in order to become a great real estate investor. At the end of today's business talk, as I mentioned, we will cover our bonus on why investing in multifamily is superior to 401k to further understand why actively investing is key to becoming financially free. Knowing what kind of income we are aiming for is one of the first things people should think about when they start investing in real estate. Income obtained through employment or other forms of labor is known as earned income. And this type of income is the income the majority of people focus on. And that's why they cannot build true wealth, because earned income is not made to build true wealth. It's made for the employee or self-employed, the person that exchanges time for money. And as we know here at Master Investor, rule number 1 in our community is that we focus and we work to build passive income and multiply money through sound investing. That's rule number 1. We focus primarily on passive income because that's the type of income that gives us total freedom. Income from a portfolio of paper assets, including stocks, bonds, and mutual funds, is known as capital gains income. Income that can come to us without any particular effort on our part right now and is not dependent on a time or activity is known as passive income, also known as positive cash flow. Although there are 3 different kinds of income that exist, here at Master Investor, we choose to concentrate on passive income, which comes from specifically from sound assets. The most notable example of passive income is real estate. Real estate investment income is the main example of passive income, making up about 80% of this category of income. Real estate is the most predictable source of investment income due to its consistent cash flow. In addition to its ability to generate sizable financial returns that increase over time, it also provides a number of beneficial tax benefits. The good news about investing in real estate is that, however, the problem is that making money from real estate investments requires a lot more planning, practice, and perseverance than other revenue streams. Only those who genuinely grasp the fundamental techniques and abilities of real estate investing can achieve widespread success, even though many real estate investors can achieve some degree of success. As we can see on the diagram on the screen, we have the cash flow pattern of the wealthy class. We have the income column, the expenses, we have the assets, liabilities, and we can see how the cash flow is flowing. We can tell that specifically our income comes from our assets column, not from a job. It comes from real estate, businesses, and different assets that we control in different asset classes. And that money that is produced from those assets come into our income column. We use that money to pay for our liabilities, expenses, including business expenses, living expenses, and any other type of expense that we want to acquire. We use the capital that we're getting from our assets to pay for our standard of living. And when we want to acquire something new, we will acquire a new asset to pay for that new item that we want to have in our life. So at the end, we can obtain everything for free legally because we are focusing on building real businesses and acquiring assets that are producing passive income, because that asset or investment is solving a problem in the marketplace. Every business is built to solve a problem in the marketplace. Real estate is a business. When it comes to investing, we will have to cover business because investing is having a plan, and it requires us to understand business in order to build a business plan to be able to invest successfully. So it goes back down to business principles and what works today and what are the new rules of money. We have to update ourselves and change the core values regarding money and how we approach money if the person still operates with the old rules of money. A lot of people, a majority of people, operate with the old rules of money, and that's why they don't have success when it comes to investing in today's age. So as we can see, the wealthy class pattern, when it comes to cash flow, it shows that we focus on the assets column, and the passive income or the positive cash flow and capital gains income too, because sometimes some of the assets that we will acquire will only give us capital gains income. That income comes from the assets that we control with our companies. Assets and money work hard for us to make us more money, even when we're sleeping. That's a true asset because it's a system of systems doing the selling and telling for us. All of our liabilities and expenses are paid from the passive income of the assets. The payments of expenses go into someone else's asset column. However, some of them can go back to our asset column because we can turn some of our liabilities into assets. It requires financial intelligence to do that. That's why it's critical that we invest in financial education. Exactly what we're doing right now, going over the business principles that work in all economies, understanding more about how to invest successfully like the wealthy do. In real estate, it's one of the asset classes that exists. There are 5 different asset classes. 1 is real estate, number 2, business, number 3, crypto, number 4, paper assets, number 5, commodities. Real estate is a great starting point to build a successful portfolio when it comes to our investments, because real estate will be here 100 years from now, 300 years from now, as long as we pick the right place. It's all about location, 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 and what we're doing with that investment, what we're doing with that property. We have to rent it out. We have to have a business in that property to cash flow so that we can pay for the loan or the debt service of the mortgage that we acquired to obtain that asset. We want to be able to manage debt well. We want to get into good debt, use that debt to invest in real assets that will produce enough income so that we can pay for the expenses of that asset, including all the debt service, interest, and also leave us with positive cash flow. And that is the holy grail, is to be able to multiply not only our capital, but other people's money, OPM. And real estate is a perfect investment vehicle to use other people's money, or OPM, or the bank's money to invest. Here are some real estate investing tactics that experts don't tell us to increase profits. The 7 practical real estate investing techniques will help us make the most money. Strategy 1, assemble a top-tier investment group or team. Remember what we talk about all the time here in our community, that one of the integrities of a successful business, there are 8 specifically mentioned in the investment and business triangle, or the cash flow triangle that we talk about inside of our community at Master Investor, where it shows 8 different integrities that must be established in a business in order for that business to become successful and to be able to last throughout generations, to become a true brand. And one of those integrities is team. So there are 8 integrities: mission, team, leadership, cash flow, communications, systems, legal, and working on ourselves through self development. We are increasing our financial IQ because we are committed to studying financial education and learning new words about the business language, which is also very important. Attempting to do everything ourselves is a surefire way to limit our growth prospects and our real estate investment returns. Feeling that we must know everything ourselves will significantly impede our progress. But a desire to learn as much as we can in any given field will benefit us throughout our career. Even more harmful is the belief that we must do everything by ourselves. The truth is that in a field as complicated as real estate investing, no one can know everything there is to know, much less do everything there is to do. Even with a great deal of effort, always seek a specific data from successful real estate investors who have been in the business for more than 50 years, like continue to learn new things with every investment. Tap into new opportunities created by today's advancements of technology and AI. As a result of their general lack of knowledge about real estate investment process, novice investors are frequently overly cautious, conceited, and therefore reckless, or just inexperienced. As a result, they frequently make mistakes one after the other. Furthermore, while making mistakes is perfectly acceptable in theory, at least smart mistakes, in fact, they can be among the best teaching tools. Too many mistakes can frequently result in catastrophe in both business and other spheres of life. Experience is the best defense against these catastrophic errors. However, when we are first starting out, how do we gain experience? We accomplish this by taking advantage of other people's experience. Some novice real estate investors now contend that they will be able to keep a larger portion of the profits if they handle all the work themselves. On the surface, that might be the case, but what these people don't understand is that the right partners can sometimes significantly raise the returns that can be obtained from investment endeavors. Strategy 2: make a tax plan. Generally speaking, no one enjoys talking about taxes, but in the real estate industry, taxes translate into more revenue. As was previously mentioned, investing in real estate has significant tax benefits only if we set up our real estate investing activities correctly from the start. Will be will be able to take advantage of these tax benefits. It turns out that a number of provisions in the U.S. tax code were specifically drafted to promote real estate investment and development. The majority, if not all, of the cash flow that our properties produce can be shielded from federal and state taxes thanks to these tax provisions, and even to eliminate some personal income taxes that are unconnected to real estate. We can deduct a wide range of direct and indirect costs related to managing and maintaining a property, including repairs, utilities, office expenses, property manager, salaries, advertising, and the like, because the government views real estate investing as a business. However, we can also write off some large phantom expenses, such as depreciation, which are expenses that are listed in the property's books, but that we don't really have to pay for our out of pocket. But we need a lot of information to maximize our tax savings. Regretfully, we probably won't have all the information we require unless we work as a tax or real estate accountant. That is another reason we need a strong team of real estate investors and professionals in order to optimize our real estate investment returns and legally and legitimately reduce the taxes we owe on these activities. Our financial team can assist us in developing a real estate investment tax strategy in advance. And that's why we mentioned that investing is defined here, a master investor, as having a plan. Because without a plan, the person, it is only gambling, is only trading, is praying that something might work, is measuring their return on investment with opinions instead of with facts, which is not good when a person doesn't know what is happening with their investment beforehand. It is a sign of lack of financial education. That's why we have to understand everything about the investment that we want to execute. We need to understand the finances if we're acquiring an existing business. We need to read throughout the entire financial statements of that business. We need to see if we want to improve the assets column of that business. Can we improve it? What's wrong with the business? Is it missing something out of the 8 integrities of a successful business that we talked about? And we need to figure out our return on investment with facts, not opinions. And that requires us to go through all the numbers, crunch the numbers, and decide based on the facts and on the cash flow, on the bottom line, whether that's going to be a sound asset or it's going to be a liability. And it's something that maybe we don't want to get involved, and we can pass the offer because we understand that it's not a real asset. And that's why financial education is so important, because it gives us the lenses that will tell us everything about an investment. And we can invest with confidence when we have financial education. Making money is easy, but holding on to it requires higher level of financial literacy. One of the most profitable ways to make money is through real estate ownership. So strategy 3 is make a legal strategy plan. However, owning real estate carries some serious risk, just like many other business endeavors. Among the most important of these are legal risk, which can include anything from landlord-tenant relations to failure to fulfill contractual obligations. Therefore, controlling our legal risk will be essential to becoming a profitable real estate investor. Because of these considerations, developing a legal strategy is a necessary addition to developing a real estate tax strategy. However, why is a complex legal strategy necessary? Is not having a good lawyer and insurance sufficient? Regretfully, no. Inadequate management of the legal risk associated with real estate investing can result in judgments against us from litigants that drastically lower the value of our assets. In the worst situation, they might even be able to seize our real estate holdings themselves. In rare instances, they might even be able to seize other unrelated assets, such as our personal home or business assets. Strategy 4, know our market. In the real estate sector, there is a well-known adage that states that location are the 3 most crucial elements in assessing a property's worth. However, the significance of a property's location goes beyond apparent considerations like how well kept an office park is or how run down a neighborhood is. It is true that location affects a property's value before geography even comes into play. It starts with the intended use of the property. And we said that earlier on. When we acquire real estate property, are we going to be renting it for what type of tenants? We need to figure that out. And a lot of people have liabilities, such as a residential home, that they could turn into an asset by maybe utilizing only a portion of the house, such as one room for themselves, and the rest of the rooms and the rest of the house can be rented out through Airbnb or short-term rentals or any other way that can create positive cash flow to be able to pay for that mortgage and create passive income. Whatever is left is the landlord's of the owner of the house bottom line, the cash flow. And now the house becomes an asset to them. And it's also an asset to the bank. It has always been an asset to the bank. They thought it was an asset to the owner, but it's only an asset if it's putting money in our pocket. And if the house income that is generated from the rentals is enough to pay for the debt service and all the expenses of the house, and then that house becomes an asset on our assets column. So how do we determine whether something is an asset or liability? Is by the way the cash flow is flowing. Is it flowing into our pocket or is it flowing out of our pocket? It's quite simple at the end. Focus on building assets and acquiring assets that produce passive income even when we're not working, because otherwise it's not an asset. It has to make money without us working. At the beginning, we have to put things together, but once it's launched, once it's out in the market, it has to bring in the clients on autopilot. It has to do the sales on autopilot because we have systems in place. And that is what we want to go for. Build a product-based business that can sell on autopilot, not a service-based business that requires a person to be there to see the clients. Successful real estate investors nearly always choose the kind of properties we want to invest in advance. Just as the majority of successful business owners began our entrepreneurial endeavors knowing what kind of goods or services we want to sell. One explanation for this is that the locational considerations we should make will depend on the kind of property we are aiming for. The local priorities of families, seniors, students, and other potential renters, for example, are likely to differ significantly if we are looking to rent an apartment. As a result, after deciding on a property type, we should carefully consider all pertinent locational factors, including transportation options, crime and safety, the proximity of schools, shops, and restaurants, population dynamics, zoning laws, property taxes, and many more. These factors will all have an impact on an area's property's value for a very long time. For many, questions about job growth are the most crucial ones to ask. It is more likely that jobs will be leaving the area or will new ones be coming in. Are the new positions paying more or do they appear to have the potential to pay less? But even then, we are not finished because fact sheets and statistics can only tell us so much. In order to get a sense of the place, we should also take a personal drive around, just like a potential tenant or buyer might. How long does it take to get to the grocery store, the freeway, or other places of business? How busy or noisy is the neighborhood during the day? How secure is it at night? Strategy 5. Project our cash flow honestly. After deciding on a type of property and a place to invest, it is time to start researching individual properties. As we proceed, remember that creating positive cash flow is the main reason we became a real estate investor. Additionally, each property we buy or acquire must yield a profit if we want to make the kind of money we desire. Otherwise, we are merely squandering our time and limited investment funds. An existing property owner usually creates a financial pro forma. When attempting to sell a rental property, both income expenses and expense items are included in pro formats. Since rent typically accounts for a large portion of revenue, we should ensure that the estimated rents are reasonable. For example, rents for the property we're considering purchasing are unlikely to suddenly increase by 10% annually if they have been raising by 3% annually in the surrounding areas. Alternatively, occupancy rates are unlikely to reach 80% or 90% in the near future if only half of the offices or apartments in the property we are considering have been leased for the previous few years. Similarly, we should consider all of the expenses related to buying and maintaining the property in question, operating expenses, or the costs associated with managing and maintaining the property, and debt servicing costs, or the interest paid on any loans we took out to purchase the property, usually make up the majority of a rental property's cost. However, there might be additional unstated expenses. Do the units, flooring, and furniture need to be replaced? Do we need to obtain any new permits or adhere to any new government regulations? How long does it usually take for one occupant to vacate and another to move in, and so forth? Many properties will be removed from our list of potential if we honestly evaluate the entire range of income and cost factors. This can be frustrating. Consider it this way: the removing properties that are high risk or low return will greatly raise the likelihood that the properties that do make the cut will have a chance of producing a sizable cash flow for many years to come. Strategy 6: provide excellent tenant service. New real estate investors frequently only consider the bottom line. As previously mentioned, our primary goal as a real estate investor is to generate profits. So that is to be expected. However, we must be cautious not to overemphasize the importance of money because we want to safeguard both our long-term revenue and our short-term cash flow. Indeed, as a real estate investor, particularly if we are renting or leasing our properties, we are in a customer-facing business, just like the local car repair shop or the electronics store down the street. Similar to them, we must look out for and satisfy our clients in order to stay in business for very long. This doesn't mean being extravagant, fitting our apartments with gold-plated facades or our offices with granite floors. However, it does entail offering residential or commercial space that is tidy, clean, and well maintained. Additionally, it entails routinely checking our rental properties to avoid issues before they arise and reacting politely and promptly when they do. If we want our properties to stay fully rented or leased, we will need to be budget for the cost of going through all of this trouble, even though it may seem like a lot of needless work and expense. If not only will our tenants tell other prospective renters about any bad experiences, and they might even leave if things get bad enough. But with the abundance of online review sites for almost any kind of property these days, one tenant's bad experience we can be displayed on a computer screen for every potential new renter to see. We don't even want to consider the possibility that these unpleasant interactions will worsen. We want to be able to handle any issues with our tenants right away. That's what's important to delegate, have a property management company as well, or create or build a property management within our company. As a branch of the real estate company, we're going to create a real estate property management, and we're going to put people in place so that we can take care of our properties. We can improve any issues that may arise along the way, and we can be there for our clients. Just like anyone else, we like to have help when we need it. We want to have, and more when we're paying a service or we're buying something, we want to have that more because they have more customer service per se. So we want to focus on delivering great products and great customer service. Not just focus on the products, but let's focus on having that experience with the customers to be able to leave a mark in their minds that they cannot forget ever. And it's a good experience. Every time they come in contact with one of our companies or brands or businesses, they have a pleasant experience every single time. And they can reach us, and we have the legalities in place. Everything is in order. And we're going to also continue that communication with the customers to find out what we need to improve. What is that they need? Maybe we can create a new product. We can bring in something new into the real estate property, a new asset that will create. Maybe they need laundry. And now we have washer machines and dryers that they can pay and they can use for a fee. So many things that we can do when we are actively investing successfully with a plan. We're not giving our money away to anybody. We have a plan, and we're using not only our money, but we're using debt, credit cards to invest, to build a business. We have control. We have a voice. That's what's important, to learn how to build businesses, to learn how to launch an idea into the marketplace, to learn how to invest in different asset classes, not just real estate, but on all the asset classes that exist today. Because that's how we protect ourselves from inflation and any down economy. That is how we stay ahead, because we have different investments that we control, and we can shut this one down because we're going to roll the money over into a new investment that we found. We have the ability to control and say what needs to happen within the investment because we created the investment. And that is the highest level of investing, is to be a capitalist, to be able to find problems in the world, solve them with a solution that is lucrative, with a plan that is helping other people, right? Because it's not for us. Otherwise, it'll be a hobby. We need to solve other people's problems. So if we are in real estate, we're solving housing problems. We're either providing housing for people, or we're providing a space for businesses to run their business. We're doing office buildings. We're doing housing, right? To house people in. So when we do these things, the government becomes our partner, because the government wants us to invest in housing. They don't want people to not have options. They want as many options as possible for people to be able to live and have a home. Same thing with energy, anything that will improve the economy and the country itself. The government becomes our partner, and the taxes and the laws are on our favor, because a capitalist country, as it is the United States, is built to pay as little as possible in taxes, because the rules and the laws are made for the business owner and the inside investor. So acquire the wealthy context, because when it comes to money, there are only two types of mindset: the wealthy and the poor mindset. And the poor mindset, we can find the middle class and the poor class in there. And the wealthy, we have the wealthy class. And it's all about understanding how to apply the new concepts about money, because money has evolved. 1971, August 15, that's when President Nixon separated the gold standard from the US dollar. Money became monopoly money, fake money, fiat money, paper money, and just an idea backed up by confidence. Today, money is a currency. Money is created with debt. Money is debt, and debt is money. That's why we must treat debt like we treat money, because it is money. So use debt to invest for passive income. Before we buy liabilities with debt, we first buy or launch assets We acquire assets with debt. We use other people's money to buy assets first, and then we use the revenue to pay for the debt service back. And we also use the revenue to buy our liabilities and get into bad debt because we can afford it, because we have assets that we control with our companies. So customer service must be a priority when it comes to building our businesses, and when it comes to real estate, is key. If you have any questions, let us know in the comment section below, and we're going to come back and answer them as we go through them. Meta 7, increase in value. One crucial idea that can be a useful tool for real estate investing is thought in the board game Monopoly. 4 greenhouses lead to 1 red hotel. That formula can be used in real life. The majority of real estate investors who stay in the business for even a brief period of time come to the realization that the abundant profits that so many of our peers make are only possible with ever larger properties. For example, if our only investment property is a starter home in a marginal neighborhood or a 150,000 duplex, it is hard to make significant profits. Trading up is the answer, moving the cash flow into more lucrative assets. Through our experience, we will be able to spot and allocate sound assets that are creating extraordinary results, extraordinary returns on investments, or ROI. And we want to have assets that will reach infinite return on investment, or also known as IROI, which is the holy grail of investment. That's when we create money for nothing. That's when we recoup our initial capital back from the investment, whether we use debt or our own capital or a combination of both. We recoup that money back, and at least we recoup our capital back that we use, our personal capital. If we have any capital that we use of our own, we recoup that back, and we continue to control the asset and the cash flow. We continue to collect the cash flow and passive income. However, now we collect more because we have recouped the initial capital back. So we cashed out. However, we still collect the money from the asset, even after we have collected our initial capital that we invested. That is money for nothing. We're literally printing money from thin air because the asset now is giving us money for free. We have no money of our own into the investment. And that's the type of investments that we want to get into and control, because that is creating money from thin air legally. Naturally, trading up entails selling a smaller or less lucrative property, cashing out, and using the proceeds to buy a larger and more lucrative piece of real estate. The only catch is this: a capital gain is what we get each time we cash out. Additionally, both the federal government and many state governments tax capital gains income, albeit at a lower rate than regular or earned income that comes from a job or a paycheck. With so much of our gain being lost to taxes, how can we make progress? We don't give up the money is the response. It has nothing to do with concealing income or breaking the law. The government actually encourages us to buy bigger and bigger properties because it creates more and typically better commercial and residential space. And they investing to become financially secure and free, even extravagantly wealthy, are the concepts presented here. However, as written, they are merely concepts. Putting these concepts into practice is the only way we can turn anything into a profitable real estate investor. We can turn any property into a profitable and lucrative real estate investment. Okay, because we can read the financial statements, we understand what is an asset, what is a liability, we understand about seller finances, how to use creativity to raise capital to acquire the property that is big, that is not just a small property using our own capital. We're using other people's money. We're using leverage. We're using the bank's money to acquire bigger properties that gives us extraordinary results when it comes to our return on investment. We want to have high performance assets giving us positive cash flow all the time, pumping in passive income into our pockets because we're solving a problem in the market. Every business, like I mentioned, every business is there to solve a problem in the world. So what type of problems do we want to solve? That's the question. Taking action now and continue learning throughout our real life experience. As here at Master Investors, we like to convey to our partners. As we do, we will discover that investing in real estate can give us the fantastic base of prosperity and freedom we have always wanted. Comparing the perspective of a business owner and an employee. To become wealthy, we must adopt the wealthy context, which is more important than the content. Majority of people in the world only think like employees, which is why they don't understand how to create true wealth. Business owners, we are aware that in order to remain competitive, we will have to pay that money to employees and their salaries of 401ks if 401ks didn't exist. Business owners benefit from a 401k because we are not required to pay the funds unless an employee chooses to participate, and they are also exempt from paying if an employee leaves the company too soon because they are not vested. Majority of people will not choose because they will not choose to invest in 401ks because they simply lack the funds to do it as they struggle with their bad spending habits. The unpleasant reality of 401ks. This is supported by research which should assist those people who continue to find this reasoning perplexing or unpersuasive. According to a 2012 study by the Center for Retirement Research, all else being equal, workers at companies that contributed to their employees' 401k accounts tended to have lower salaries than those at companies that gave no retirement contributions, as reported by Stephen Gendel of Time magazines in an article titled How 401ks Make Many Americans Poorer. Indeed, for numerous workers, the pay decrease was approximately equivalent to the magnitude of their employer's possible contribution. In other words, in order to compete with businesses that offer 401ks, those that do not have to pay higher salaries, instead of having to match it and save it in a tax-deferred retirement plan when they have no control and incur high fees, those employees of those companies simply receive their money as part of their salary. When it comes to exorbitant fees, the average 401k plan keeps 80% of the earnings. If the investor is lucky, they might get 20% of the profits. It is difficult to believe. The investor assumes all of the risk and contributes all of the capital. The 401k plan assumes no risk and contributes 0% of the funds. Even if they lose money, the fund still makes money from fees. A 401k typically puts 20% of the person's money in their pocket during a bull market. For example, if they had 10,000 in their 401k and earn $5,000, their 401k made $500 in profit, but they only receive $100 before taxes. With a 401k, we now need to realize that taxes work against us. The tax rate on long-term capital gains income is reduced to about 15%. Fantastic. The 401k treats any gains as regular income or ordinary income, which is the only issue because it's the highest tax income that exists, earned income, the income of an employee. The highest rate of taxation, up to 35% at times, is applied to ordinary or earned income. Additionally, there will be an extra 10% penalty tax if the person, amateur investor, wishes to withdraw the funds early. The tax code is designed to work in our favor when it comes to real investment assets, so we won't be taxed everywhere. Things worsen according to accurate calculations. Inflation rises more quickly than any 401k when a government ingenuity is absent. That implies that they are losing money. Addition the 401k to invest with control to retire wealthy. The first step is to commit to investing in financial education. The more we know, the more control we can have over our investments and financial decisions. And we stop giving our money away to anybody, including fake assets like the 401k, because the 401k, all it does, it takes money away from the investor. It doesn't really put money in their pocket unless they make a profit. And if they want to withdraw that early, they have to pay for those fees. So it's a liability because it's just taking money out of their pocket and it's not really putting any money into their pocket. And they have no control whatsoever on what is happening with that money. And we want to have control when it comes to building a wealth. We want to master how to not only use our capital, but other people's money. And people that invest in 401k, usually they're using their own money. They're using the money that they're making from the job. So that shows a lack of financial education because, as we know, only lazy and financial uneducated people, when it comes to money, financial uneducated people uses their own capital. We have to be more creative to be able to not only use our capital, but use other people's money legally. Use the bank's money to raise capital from private investors, from banks and other institutions that are willing to give us money because we have a sound investment at hand. We put the deal together, we attract the money, or we will find the money because we have a sound asset. Money is attracted to sound assets. An essential component of investing is control. As previously stated, a person has no control over their investments with a 401k because they typically invest in funds and indexes that are managed by brokers, who in turn are managed by bankers, who in turn manage companies that are managed by boards. We need to be financially educated and in charge of our finances and investments if we want to be wealthy, because they have a great deal of control over their investments. Investors like master investors, financial education, prefer to make our own business investments, buy real estate, and develop our own products. In general, a good matrix is one in which our potential return increases with our level of control. Our potential return decreases as our level of control decreases. Naturally, investing in things over which we have control requires a high level of financial intelligence because many crucial decisions must be made. For this reason, most people probably don't mind being forced into a 401k or a fake asset because it's something that doesn't require any financial intelligence at all. It's done for them on autopilot. The money gets taken out of their check. They don't know, they don't make the decisions where to invest the money. They just praying that whoever is investing their money is going to do a good job. By the time they want to get their money out, hopefully there's any money in there. And there's no promise that there will be any money in there. because of lack of control. This is due to the fact that the majority of people lack basic financial knowledge and are unsure of how to spend or save their extra cash and how to multiply that money, because rule number one in our community here at Master Investors is that we work to build passive income and we'll multiply money in sound investing. Bonus: why investing in multifamily is superior to 401k. Keep in mind that 401ks are for the benefit of the employer, not the employee. With a 401k, a person might be losing more money than they realize. Remember that greater control equals greater return when it comes to business and investing. Purchasing a modest multifamily building, residing there, and maintaining it for cash flow is a legitimate choice for people who are approaching retirement. We say it was a great time to start investing today in apartments because of low interest rates and low prices. However, we can invest in any economy because we always invest with a winning plan that is made with facts. Additionally, we know that rents are rising in the majority of states and that renting rather than buying appears to be the long-term trend in the US. This was good news for landlords. Real estate, when pegged properly, is a proven and future-proof formula for wealth. As long as the location of the real estate is right, then the real estate will be there forever. In many cities, rents are still rising rapidly. Furthermore, as we recently established, the 401k continues to deprive the majority of people of their retirement funds. Given that we have been promoting cash flowing real estate as one of the best investments for years because of its leverage, monthly cash flow, and tax advantages. Using other people's money, or OPM, it is always preferable to use other people's money to generate cash flow or passive income. This is fairly typical in the world of real estate investing. We may only put down 10% of the total cost of a property, and that 10% can also be put down through a credit card or a loan or some sort of debt that we can acquire to put that 10% down. So the entire deal, 100% of the deal, can be financed. We can raise the entire capital. So in reality, we don't need money to make money. We need knowledge. We need financial education, and we need to have a sound asset so that we can attract the money from the right sources. With the remaining funds coming from a bank or private individual and still be making money. Consider this: for just $50,000, we can purchase a $500,000 property. $500,000 property that generates more than $5,000 in cash flow each month. Appreciation is the gradual rise in the property's value. We can raise our rent rates if we can properly maintain our property, look after our tenants, and plan ahead. Our expenses decrease as the rent rises. The property's value rises as a result. Control. When we own a property, we have authority over its earnings and outlets. We have control over the assets, liabilities, the income, the expenses. Therefore, our property is immune to market fluctuations if we can maintain cash flow from it. Tax benefits. Owning real estate properties or controlling them has certain tax benefits. We are able to deduct depreciation from our revenue as an expense, not to mention the tax credits that are available if we restore a historic building or provide low-income housing. When considering a tax credit, the amount is taken straight out of our taxes at the end of the year. Finally, deferral of capital gains income taxes. The capital gains income taxes will be deferred if we decide to sell our property and reinvest in another one that is more lucrative. Multifamily investing essentially offers everything that a 401k does not. Nevertheless, there are a few factors to take into account that are deferred. Employ a property manager. Why invest the time and effort to rent, manage, and maintain an apartment building when we are purchasing one? Especially if we are inexperience? Who wants to spend their golden years changing locks and repairing toilets? The ability to account for property management when purchasing an investment property is one of the best things about multifamily investing. Look for a deal that will support professional property management and generate income. Investing should be our priority, not management. Finding just one building and taking on the responsibility of managing it, it seems short-sighted to many investors. Instead, start investing and look for more fantastic offers that we can buy and have handled by a professional. And like we mentioned earlier, we can create a property management company to handle all of our properties, and we can deduct business expenses from that management company on our business deductions. In our free time, educate ourselves about the market, find better deals, round up investors, and increase the value of our portfolio so we can use it to leverage further deals, and also invest in different asset classes to move our profits into new asset classes to create more passive income, and sometimes we will have capital gains income. It all depends on the type of asset that we want to acquire that will increase our wealth and give us a reason to live in retirement. No matter our age, get started now. Investing and business are both team sports, and there is not an age limit as to when anyone can start investing. The younger we start, the better for our financial future. It is legal to learn about business and investing at any age. It makes sense for people who are getting close to retirement to think about multifamily investing, but it makes even more sense for the young people who are reading this to start investing or listening to our podcast. Youth is wasted on the young, as the saying goes. Don't waste our childhood. Instead, start investing for the future by paying for our financial education and assembling a collection of assets that will support us and our loved ones when the time comes for us to retire. Investing has no age to start. Anyone can start investing with controlling guidance. When we are young, start small, and as we get older, build big. Read our financial literacy through e-courses and e-books. We are releasing new books very soon. How to raise capital to build wealth, and how to invest in real estate like the wealthy. Find more on our website for additional resources and tools on multifamily investment and management. Remember that there are 5 asset classes today. We should invest in all of them with a winning business plan. That is how we thrive during any type of economy, diversifying among all the 5 asset classes that exist today. It's key to hedge for inflation and protect ourselves for a down economy. As a business owner and inside investor, we know that the market goes up and down. Diversifying among all the asset classes is how we continue to thrive in any type of market. We must acquire financial education to be able to shift to the wealthy context, which that is what makes us wealthy. The type of context that we have must be the wealthy context. The 3 E's of an inside investor are financial education, financial experience, and excess of cash flow. We must acquire the 3 E's of an inside investor: financial education, financial experience, and excess of cash flow. That's when we know that we are successfully investing like the ultra wealthy, when we have acquired those 3 E's. The key is to master using debt to invest for passive income and creating tax-free wealth legally. Start investing in high-quality financial education here with us at Master Investor. We have 3 books available on our stores right now. Go to our website, click the link somewhere in the description of this talk. We have the 10 New Rules of Money, how to build cash flow with the internet, turn passive income on, and how to invest in crypto to build wealth, understanding Bitcoin and blockchain, the rise of legitimate reserve digital currencies and assets. Go get our ebooks and get more tools on our website. We have Instagram, podcast, we have a newsletter, we have YouTube, we have TikTok, Facebook page, Discord. Make sure you get plugged in with our resources. Master Investor's mission is to be the global, authentic brand of money, business, and investing that elevates the financial well-being of humanity through high-quality financial education. Made simple, we look for opportunities to build passive income, win-win partnerships, and true wealth. Any questions, drop it in the comment section. I'm going to come back and we're going to dialogue on that question, whatever that is that you may have a question on. Make sure you write it down. Let us know your thoughts about today's talk and take massive action, because when it comes to building true wealth, we need to acquire the information and apply that into our life. That's how we turn somebody else's knowledge into our knowledge, is by applying it into our life. We must do that. So the key is to learn something new every day about money, apply it, get the results, and then teach somebody else how to do that. And that's how we begin to improve little by little. Get our ebooks, get into our inner circle, go to our website. We have plenty of tools. We have a lot of articles published online already, filled with high quality financial education. Go grab them, sign up for our newsletter so that we can get all of the articles that we publish via email, and we can start building a winning plan with ease and guidance. Thank you for having me again here on another valuable talk on money, business, and investing. Subscribe, share, and leave a comment, bringing you the good and bad news of money, the business principles that work in all economies. Today we cover how to invest in real estate for cash flow. We talked about the 7 proven strategies to win at investing and secure our retirement, and how to use other people's money, how to use debt to invest for passive income and create tax-free wealth. Stay extraordinary and wealthy. I'll talk to you on the next talk. Thank you.